So now that we have looked at some secrets about how money works and what causes the stock market to crash, we can move on to how we can get started investing. The first step to investing is to pay yourself first. Now, this could make or break your finances. Warren Buffett once said, "Don't save what is left after spending, spend what is left after saving." This was such a huge revelation for me that it completely transformed my portfolio. Before I knew this, I was struggling to save. I didn't know exactly how much I was saving each month, and I was not systematic. But once I learned this, I made it a point to set aside a big portion of my paycheck every month and immediately put it inside my investments. And that really turbocharged my results. And I'm sure it can do the same for you. The reason why this is so important is because of compounding interest. So let's look at how a typical investing journey would look like if you do pay yourself first every month, as opposed to if you don't. So here's a compounding interest calculator. And as they say here, compound interest means that the interest you earn each year is added to your principal so that your balance doesn't merely grow, it grows at an increasing rate. Is one of the most useful concepts in finance. So let's see how that works. Let's say you have $3,000 available to invest. And let's say your average rate of return is 10% because historically the average stock market return has been 10%. So let's assume that you get a 10% return next year. So after 1 year, what you have is you have the 3,000 plus you made a 10% return, and 10% of 3,000 is 300. So now you have 3,300. Now what you do is you don't withdraw that $300 and go spend it. You reinvest the $300. So let's say you start with $3,300. Then after 1 year of 10% return, what you would have is you would have 3,630, because this year you made 10% of 3,300, which is $330. Last year you made 10% on 3,000, which is just $300. So now you have 3,630. So let's put that in here. Now 10% of 3,630 is 363. As you can see, in your first year you made $300, then you made 330, and now you're making 363. So your return in absolute dollar terms every year is increasing, and that's because of compounding interest. That can only happen if you reinvest all your returns. So let's say how much you would have after, say, 30 years of investing. Let's say you start off with $3,000 and you get a 10% average per year. Let's see how much you would have after 30 years. You would have about $52,000. Now let's say you make it a point that every month you're going to save $100, and therefore your annual addition, which is $100 a month, is $1,200 a year. So let's say that in addition to this $3,000 that you started with, every year you add another $1,200 to your portfolio over the next 30 years. Let's assume you get the same rate of return, and now is when the magic happens. Instead of $52,000, you have $249,000. It's almost $200,000 more than what you would have had if you had not been saving every month and adding it to your investments. That's how powerful it can be to always pay yourself first and every month channel a portion of your income towards your investments. The best way I found to do that and what has worked for me is that the moment I get my paycheck, I set aside a portion of it for my investments. So there's no temptation to spend it. There's clear visibility that I have this much earmarked for investments, and therefore this month I only have so much money to spend. And I have to buy whatever I want to buy within that budget.